Okay, gains and losses due to uncertainties. The idea is that we are using estimates that are, 30 years out here. So, we're saying, what if we had to reevaluate something? So let's say that the employee's salary we've decided to really going to be more like $420,000. So now let's redo our numbers based on $420,000, and it looks like we've got a $9,000 loss because we're going to need to put more away in the PBO. So with that being the case, that is one of the gains and losses we've got here. So if you look at what we've got here, we've got the PBO at the beginning of 2016, 158,341. That was from a couple of slides ago, plus the service cost of the next year. I think that was 158,341. Okay, 158,341 plus the service cost, 15,258, plus the interest cost, which is 158,341 times the discount number being used, 9,500, and it does work out. I did the math. And now we've got a loss on the PBO being calculated here. So the idea is, right, this is how much we had, our obligation was. This was the increase in obligation. This is the interest cost because the obligation is kind of like a liability to us. And the loss on the PBO because now we owe more money. So now our PBO at the end of 2016 is 192,254. Okay. If it went the other way, if we had a lower obligation, maybe the salary was really more like $380,000 is what our estimate was, well then this would be a gain on PBO. It would be a reduction versus an increase. All right, payment of, and obviously the PBO, because it's a pension benefit obligation is reduced as benefits are actually paid out to the employees. It's like kind of paying off a liability. So here's a summary of what we just did. This is a gain so think about it, this is an obligation, this is like a liability. So increase or decrease. And once employees are paid with retirees, you start reducing the obligation. Okay, so what if we were only looking at the one person? Let's talk about, like, let's say we're looking at everybody, all right, which you imagine is quite complex. I'm sure there are programs that help with this now. But let's look at big picture. So let's say you had a PBO of global communications for $400 million, and you had service cost of $41 million, and some of these amounts are assumed, they're just being given to us. Interest cost would be $400 million times the 6% discount rate, $24 million. This is being given to us, the loss of gain on the PBO, and the retirement benefits, these are assumed as well. So let's move on here. Oh, did I want to do a problem? Let me see. Okay, I'll do this problem. Read it, pause it, read it. So what we're looking at here is they're giving us the pieces of information. They give us the PBO at the end of the year. They didn't give us the PBO at the beginning of the year. That's what number we're looking for. They told us the interest cost. They told us the benefits paid. Well, the interest is based on PBO at the beginning of the year times the discount actuarial rate, 8% in this problem, gives us 7,200. So we can just do the division here, 7,200 divided by 8%, and we find out the beginning PBO is $90,000. So the idea is we can figure out missing pieces along the way. I wanted to share that one with you in case you have a homework problem like it. Okay, moving forward. All right, so this is what I was saying earlier, is that the money is not being held by the company. Instead, it's held with a trustee. That's where I was saying Morgan Stanley, Fidelity, whomever. And the idea is they invest the assets. Assets accumulate earnings, and then at the end of it, they pay the benefits out to the employees. All right, so plan assets is what we're looking at now. Plan assets are the assets that are sitting with the trustees. So the idea is that these aren't just sitting there in a bank account like under a giant mattress not earning any money. They are earning money. And if they do really well, that means that the cash contributions that the company has to put in is less, right? But if the return on the plan assets is not good, then the company will have to put in more because at the end of the day, they have to have enough for the PBO, right? So if you're looking at this plan assets at the beginning of the year, how much money did the plan earn, plus the contributions from the company for that particular year, minus what was paid out to employees, the ending plan assets would be 340, and all that information is in here. It does say it's underfunded because they tell us that Global's PBO at the end of 2016 is $450 million. So $450 million, they've only got $340 put away. They're underfunded by about $110 million. Okay? And I mean, you probably hear about these things when we talk about the state pension plan and such, and that's what they're talking about, what they're underfunded. It doesn't mean that the employee pension plan has nothing. It just means it does not meet its obligation, and unfortunately, it's pretty dramatic how much it doesn't meet its obligation. Okay, so expected return on plan assets, right? So how much the employer puts in, just like a bank account, right? Plus any returns, right? That adds to it, gives us how much money we have to work with. If we get a great return on plan assets, then good. Then the employer pays less money. Okay. Okay, and this is what I was saying before, is that with the example they gave us, we're underfunded by $110 million. That would show up as a pension liability on the balance sheet if it's underfunded. If it was overfunded, it'd be an asset on the balance sheet. I can't imagine that happens all that often. All right, so I left this in here because of the journal entries. Brendan Health Services reported a net loss, accumulated other comprehensive income in last year's balance sheet. This year, the company revised its estimate of future salary levels, causing its PBO estimate to decline by $24 million. Also, the $48 million actual return on plan assets was less than the $54 million expected return. So basically, we have two sets of journal entries here. We have that the $24 million, they revised their future salary levels, but our PBO went down by $24 million. Good for us, right? Good for the company, rather. I don't know whose side I'm on here. Good for the company. So your obligation, which is a liability, went down, and you've got a gain in other comprehensive income. Now, the reason it winds up in other comprehensive income, from what I understand for all of these, is simply because, especially accumulated other comprehensive income, because you're going to have fluctuations here, and you're talking about 30, 40 years, so you don't want to hitting your income statements regularly, because an increase this year may be a decrease next year, and you don't want to show volatility in these things. All right, and on the flip side of it, the other piece, the $48 million actual return on plan assets was less than the $54 million expected, so that sucks, right? Oh, sorry. Good. It's getting late, and I'm doing these. So the plan assets, you're reducing them. You've got a credit here, and you're taking a loss because you didn't have the return on plan assets that you had expected. So there's your loss piece of it. So it's a two-part journal entry, or two separate journal entries, really. Okay, so read through this. All right, so let's look at this information. Let's hold off on the prior service cost part of it. These are the components of pension expense from way in the beginning we were talking about this. Service cost and interest cost for the year were $10 million and $4 million respectively. All right, so service cost, there you go. Interest cost, $4 million. At the end of the year, there was a negligible balance in the net gain pensions account. All right, so we're not worried about that. We're not going to worry about that part of it. At the end of the year, the actual return on plan assets was $4 million, though it was expected to be $6 million. Now, this seems silly, but you put a minus $6 million in here because the idea is that your return was $6 million. Your return was really $4 million. For whatever reason, the FASB decided it was a good idea to use the estimated amounts, not the actual amounts. I don't know. They said it was something to do with showing less volatility. So anyway, we'll talk about that a little bit more later, but again, this is the FASB decided that the amount that should go into pension expense should be the expected amount. So even though they only made 4, you're going to show 6 here. The piece that they want you focusing on here is this amortization of prior service cost. They had a prior service cost of $20 million. They don't want volatility in these plans. So if you have that being the case, and the employees that are affected by this have a remaining service life with the company of 10 years, we spread it over those 10 years. So the $20 million of prior service cost divided by 10 years. So every year for the next 10 years, you're going to have this $2 million adjustment. Okay? And so our pension expense then is $10 million. All right, so these are all the pieces that play into this. I left this slide here even though it's a lot to read, but because it's all the pieces we talked about. Service cost, interest cost, right? What goes into the PBO, what goes into pension expense, what goes into the plan changes in the plan assets, and how do they all kind of work together. So take your time and take a look through that. All right, so let's look at this. So we've got the information for a PBO. We've got a new company. Well, we've got a company or Global Communications. Maybe it's the same one. I'm not sure. Here's the PBO, the projected benefit obligations for 2016. Here are the plan assets for 2016. We are underfunded by, $110 million. So that's a concern, right? Assume a prior service cost of $60 million was incurred at the beginning of the previous year, 2015, due to plan amendment. So increasing the PBO. Also assume at the beginning of 2016 had a net loss of $55 million. Previous year's losses, the average remaining service life of employees is 15 years. Okay, so we're going to take that information and we're going to move it on over here. So the idea is, how do these play into pension expense? So we've had $400 million beginning in 2016, 41 being the service cost. Here we go, service cost. We're trying to say, how do we calculate what pension expense is going to be? So these numbers are over here, right? 41 million is the service cost. That is the service cost for this year. The interest cost, 24 million, which is calculated 6% times the 400,000. Because it's interest on the obligation. Expected return on the plan assets. This is what I said before. I don't know why. FASB decided to use the what you actually had. The actual return on plan assets was 30 million, but you really only expected 9%. So that's really 300,000 at 9%, 27 million. So you reduce your pension expense by the return on the assets, the amount, how much they've grown. Amortization of prior service costs that we calculate later. Amortization of net loss we're going to calculate later as well. Our pension expense is 43 million. Those are the components. That's where everything comes from. Okay, and here's all the pieces that I was saying, right? Kind of broken down. 41 million is the service cost from the increase in the PBO because employees worked another year. The interest cost, as I said, it's 6% on the 400 million PBO. The, again, expected versus actual. I don't know what to tell you. You have to use the expected amount, not the actual amount. See, here you go. Expected return, it reduces it. Okay. That's what it's saying, right? So we'll talk about that. Okay, so now let's look at the amortization of prior service cost. There was $60 million at the beginning of 2015 that they said needs to be amortized. So $60 million over 15 years, $4 million a year, because that was the average life of the remaining, or rather working period of the remaining employees that would be affected, right? Okay, more of that. All right, amortization of net loss or gain, okay? So they're reported on the OC in the other comprehensive income as they occur. Let's actually look at the numbers on this one too. Ooh, where's the numbers? There we go. All right, so what happens here, I don't know why, okay. If the PBO has a loss that's higher, or if the PBO is higher than expected, your obligation is higher than expected, you have a loss. If your obligation is lower than you expected, you have a gain. If you have a return on plan assets that's higher than you expected, you have a gain. If it's lower than expected, you have a loss, okay? So let's talk about that gain piece. They don't like fluctuation. That's something important. So if you have a gain or a loss that is too big, and by too big they mean if it exceeds 10% of the PBO or 10% of the plan assets, whichever number is higher, I would imagine the PBO is normally higher, then that is referred to as the corridor. So 10% of the amount of the gain or loss has to exceed 10% and usually of the PBO. All right. The idea is that if you have a gain or loss that's higher than that, then you are in fact going to include it in this calculation. But beyond that, it doesn't even get included all at once. Instead, you spread it out over a number of years. Okay, so here's a number they told you before. Net loss, you had $55 million of a loss. That was in the original data. 10% of $400,000, which is the PBO, is $400,000, right? So to the extent that loss exceeds the 40 million there, which it does by 15 million, that is the loss you're going to show. But you don't show it in 1 year. You show it over the service period of those employees. So 15 divided by 15. That is the $1 million a year. So we're talking serious income smoothing here is what's going on. All right? And there's your $1 million there. Okay. All right, let me move on to another round.